What's going on, guys? MMuniz here. Welcome back to the channel. It is a sad time in the stock market right now. People are losing thousands, tens of thousands, even hundreds of thousands of dollars on a weekly, daily basis. Needless to say, 2022 has not been a good start for the markets. Let's actually take a look. So right here, we're looking at year to date for 2022. Now we have a bunch of the indexes that people follow. We got the NASDAQ, the Russell, S&P. And you notice the NASDAQ is down almost 22%. That's officially bear market. The Russell down almost 20%. S&P 13%. DJI not so much, but take a look at that. Kathy Woods and her famous ARK Innovation ETF. If you had invested in that back in 2020, you would have made a lot of money. However, year to date, down 51%. And also, if you go off all-time highs, these aren't even the total drops. ARK is down almost 70% since its all-time highs. So if you had invested in ARK back in the beginning of 2021, you'd be down almost 70% right now. That is insane. So the results are in. The first quarter, GDP was negative, which means we're halfway to a recession. And more than likely, we're probably going to see the same thing in Q2, if not even worse. Now, this is just my opinion, but I'm pretty sure it's going to be even worse in quarter two. The reason I say that is in the past, we had the stimulus checks, we had child care tax credit, we had all sorts of stuff boosting the economy. Right now, everything is going in the reverse direction. Inflation is through the roof, rates are going higher. There's not much in terms of what's going to stimulate the economy. To my knowledge, I don't know of anything that's actually planned in the future. The only thing I can think of is that they keep putting the student loans on pause, which some people with college debt are fans of, and student loan forgiveness, which has multiple opinions on that. However, none of that is guaranteed, so we don't know what's going to actually happen there. But at the end of the day, with or without a recession, when it comes to a bear market, how does one invest? How does one protect their nest egg and their portfolio over time? What options are there to grow your portfolio and how to keep it safe? Well, there's a bunch of options, but it all comes down to three questions. What is your current financial situation? And by that I mean, are you employed? How long do you plan on being employed? Is your job secure? What is your investing timeline? Are you already retired? Are you 30 years from retirement? That is very important. And the third thing, and this goes down to investing in general, what is your risk tolerance? Some people have no issues with risk at all. Some people don't want to risk anything. They don't want to lose a penny. Everybody's different. So I'm going to go over some different options you have when it comes to investing and where to put your money in a time like this. And each of those three questions are going to apply. So starting with option one, this is the worst option in my opinion, but I'm not a financial advisor and this isn't financial advice. You can sell out of all your holdings and hold cash until the market bottoms. You're going to catch the rally and become a millionaire. If you could do that, you're an all-star. To this, I say good luck. In theory, it sounds great and it sounds easy. Technically, if you were able to time the bottom of the S&P 500 back in 2020, it was mid-March, you would have seen growth of your $2,300 investment grow all the way up to $4,700 in just 2 short years, a gain of over 100%. However, we live in reality, and this just does not happen. What's more likely to occur is that you're going to sell out of your positions, you're going to try to time the bottom, but you're going to end up missing it, essentially missing out on gains if you had just continued the dollar cost average, which is something that I preach all the time. Always remember, time in the market is going to be timing the market. Now, there are some people that get lucky, but like I said, that is super rare. So my opinion is take away the guessing game. Don't try to time the market. Just continue to invest on a weekly or monthly basis, whether we're at all-time highs or all-time lows. The only people that should even consider timing the market and making a risky play like this is someone that has a long timeline left, someone that doesn't have to support a family. Maybe they have a pretty good income right now and they don't mind putting a lot of their money at risk to make a big play. There's nothing wrong with that. It's really hard to become a multimillionaire without taking risks. So the option's up to you. Now, another option you have is to just hold your cash under your pillow or in a savings account or checking account, or a little bit better than those would be a high yield savings account. But at the end of the day, those are all basically the same and your yield is essentially zero. When we combine this option with how inflation has been trending, your money quickly becomes worthless as your purchasing power is destroyed. Americans' inflation trend is horrendous right now. Let's take a look at it. Looking at the past year, inflation continues to be on a steady incline. Our most recent inflation reading came in at 8.5% year-over-year inflation when compared to March of 2021. We still don't see any decrease in the rate of inflation either. As you can see, the trend continues to go upwards. This is pretty scary, to be honest. Now, luckily, the Feds are stepping in and essentially forcing a recession by raising the borrowing rate by 25 to 50 basis points multiple times this year. At least that's the plan. Now, the first increase came in March of 2022, and the Fed approved a 0.25 percentage point rate hike, and it's the first increase since December of 2018. Now, the current plan is to do this 6 more times before the end of the year, and ideally, they're going to end up with around a 2.5% rate when it comes to the Fed funds rate at the end of the year. Right now, our man Jay Powell has been hinting at a higher rate increase of 50 basis points this time. And what many people are thinking is that this is going to get us to that 2.5% earlier on in the year. So they may start to slow down towards the end of the year. So now these rate hikes are tied to so many things. It's pretty crazy. Mortgages, for instance, people that can currently afford a $250,000 house with a 3% rate. Well, that would have been back in January. But as of March, once the rates went up, mortgage rates are getting closer to 5%, 4.5%. Now that $250,000 house that they can afford, maybe they can only afford a $220,000 house because they're going to be paying more interest. Companies aren't going to borrow as much money to grow. It's going to cost them more money to borrow money, so they're less likely going to be investing in their business. The Federal Reserve is trying to curb inflation, but only time is going to tell if they're going to be successful. So really, leaving your money just in cash, even in the savings account, we're going to look at a couple in a second. It's just not a good option with how things are currently. Now, it may change. The other thing about the Fed funds rate is as that goes up, theoretically, savings rates should increase as well, but we haven't seen that yet. And I always say companies are going to be quick to raise prices, but when it comes to giving more to the consumer, they're going to be a lot slower. So banks are going to take longer before they start giving more return to the people that keep their money there. So at the end of the day, you're going to have a lot of options when it comes to savings accounts. In that high yield category. I personally use ALI, which has a 0.5% return right now. However, Lending Club has a 0.7, Discover, Capital One. You have many other options. But what I found is it's not worth it for me to move my money from one bank account to another unless there's like a large sign-up bonus or a huge rate increase. For me to go from a 0.5 APY to a 0.6 or even a 0.7, it's just not worth the time, and I'm not going to do that. The people that this option would apply to would be someone that has zero risk tolerance. You don't believe investing, which is crazy if you're watching this channel and that's your thoughts, but here we are. Or maybe you're retired and you want to have more cash on hand. You don't want to keep your money in the markets. That's fine, but there's definitely better options. My opinion is if you have time to invest, leave as little as possible in cash and then be a little bit more risky so that your money can actually grow rather than sitting there and just becoming worthless essentially. So another option that you have would be invest in something like I-bonds. Now, I've done a video on these in the past and they can get a little bit complex. So if you want a detailed description of how they work, there is a link in the description below and also a card up top. Basically, I-bonds are meant to protect your cash from inflation in a safer way than stocks and a better way than savings accounts. I-bonds have a variable interest rate that is based off of a fixed rate and a composite rate, which is adjusted for the previous 6 months of inflation. Currently, the yield you'll get on an I-bond for May of 2022 through October of 2022 is 9.62%. That's pretty impressive for a bond. Just remember that the rates are variable. They change every 6 months, and with everyone actively working to lower inflation, these yields in theory are going to lower over time as well. Now, there are some slight tax advantages with I-bonds, but for more information on that, you're going to need to watch that video I talked about. So the bonds option is good for anyone who is comfortable in their current financial situation, but is scared of potentially an insane crash coming. They think that the markets are going to drop another 40% or 50%. This is definitely a low risk investment, and it's more catered towards people that are already in retirement that don't have time to stand up to possible future volatility in the markets. I also think bonds are a good option for someone that is pretty heavily in the markets already and they just want to diversify their portfolio. Maybe they haven't gotten into real estate, but they don't want to be just in the markets. So they're strong financially and they're just looking to diversify their portfolio a little bit. That could be a good option as well. Now the next option is actually going to be broken into 2 parts. And this one is all preference, and I'll let you know what my preference is at the end. The option is to continue to DCA or dollar cost average into your current investments and to continue to follow the plan. If you like individual stocks and companies and you have the time to do your research, or maybe you just thoroughly enjoy learning about companies or believe strongly in them, then this is a great opportunity for you. As long as you feel strongly in the current leadership and how that company's doing and future growth of that company, you may be able to catch some steep discounts. One company that comes to mind for me right away is Netflix. Take a look at this. As you can see by this chart, Netflix year to date is down almost 70%. Amazon, a large cap company, is down 30%. Now these companies are companies that I wouldn't expect to fail in the near future. Doesn't mean they won't, it's just my personal opinion. Now, like I said, I don't have time to do the research into companies like that, so I can't say, what's gonna happen in the future. I just feel like they're companies that provide value. I don't have any holdings in either of those examples. Those were just specific examples. So if anything, if you follow the DCA strategy, it doesn't matter if the stocks are at all-time highs or all-time lows. Over time, your cost basis is gonna average out and your profits are going to grow as the company grows. Or if it fails, then your portfolio is going to fall as well. Now, the second part of this option, and this is my personal preference, is to continue to invest in index funds. So something like VOO or VUG, SCHD. The reason I like this is because you're still getting the growth from companies, you collect the dividends, stuff like that. But if a few companies fail, you have built-in diversification without the time and effort of researching companies to see what their leadership team is doing. Through passively managed funds that handle situations like that for you, you really have hands-off investing. You got to ask yourself, if you could have one business and potentially make billions off of it or lose everything, or the other option is you could have a piece of 100 businesses and there's a high likelihood that they're successful and there's some likelihood that some are going to fail, but you're not going to drop as much, what option do you take? I personally prefer a little bit less risk and, just like I said, the time aspect. So when it comes to this option, investing during a bear market or recession, if we're using the DCA strategy, I think that's for someone that just has average risk tolerance. The more risk tolerance you have, then you may start to specialize in one field or one company a bit more that you really believe is going to come back. Like I said, maybe you believe that's Netflix, just an option. Or you're just putting your money into the markets with faith that the US economy is going to continue to grow over time. So it doesn't matter if we're investing at highs or lows, we just do what we do. At the end of the day, there's no right answer for how to invest in a recession or a bear market. Recessions actually happen a lot more frequently than you would imagine. Since 1857, a recession has occurred once in every 3.5 years. So that's pretty common. I feel like the best advice is to live below your means, maintain a balance, so make sure that you're not just saving every penny, but having a good life that you can afford, and then try to stick to your original investing plan the best you can. If you're already in retirement and have to deal with times like this without income coming in, well then you might have to deflate your lifestyle a little bit. Maybe you have to just scale back and not go on vacation this year. But when you get a raging bull market, maybe go on 2 vacations that year. Make up for it. It's up to you guys. With that said, good luck to everyone watching the video still with your investing goals. Thank you so much for watching. If you haven't already, make sure you smash the like button down below. Subscribe to the channel. We do weekly videos on anything finance or fitness related. Take care, guys.